Today in this video I am analyzing FMCG companies, and these are also multinational companies. These are fast moving consumer good companies. The results are up to date till June 2019 for all of these companies. This is a very interesting video because I don't have investment in any of these companies, but I am analyzing them because these are highly rated companies which a market have given a very high premium for these companies. Let us begin with the current market price and equalize it for the face value. Here we are trying to understand which company's share price is most expensive when we equalize all of these face values to 10. Hindustan Unilever. We are analyzing 4 companies: Hindustan Unilever, Procter & Gamble Hygiene, Colgate Palmolive, and Gillette India. Hindustan Unilever's current price is 1843, but its face value is 1. So we multiply the face value here by 10 to get the actual value of the share at 18,434. So these shares were split into a face value of 1. So the current price is 1843, which does not mean it's cheap. The actual price of the share would be somewhere around 18,000 when considered for the face value of 10. P&G's face value is 10, so there is no increase or decrease in the price for comparison sake. So its current market price is 10,255. Colgate's face value is 1, so we multiply it by 10, so it becomes 12,000 as the current price for each share. Although current share price is 1200, but when we multiply it by 10 to compare it with the group companies, we get a price of 12,000. Gillette is trading at 7,035. The companies split their shares so that more investors can participate and there is less chance of manipulation. So in that case, HUL, I'll be using short forms for all these companies. HUL's price per share is the most expensive, followed by Colgate's and P&G, and finally Gillette. So Gillette is the most lowest priced stock. Next, let us look at the percentage fall in price for all of these scripts from where the price was 1 year back. HUL's price 1 year back was 1,871 and it has just fallen 1%, so it is very near to its 52 weeks high. There is not much fall in this script. P&G has fallen 9%. From 11,000 it has fallen to 10,000. Colgate has fallen by 12%. And Gillette has seen a fall of 11%. So none of these companies have actually fallen much from 1 year back. So they wouldn't give us much opportunity to buy into the script. Let us look at the earnings yield, that is the profit earned on each share based on the current share price. So we use the earnings per share and divided it by the price and multiplied by the 100. HUL's price was 1843 per share and it had earned 28 rupees in 2019. That is an yield of 1.5. P&G's price was 10,255 and earning per share was 124. That is, it was returning 1.2% on the price. This is the profit generated, 1.2% of the profit generated on the price we are paying per share. Colgate was giving 2.3% return on the current price and Gillette's return was 1.1%. All of these companies are giving a very low return when compared with the price we are paying for the company. Even bank FD would give you more than 6 to 7% per annum. Price to earnings ratio calculates how many times more we are paying for the earnings of the share of the latest year. HUL's price was 1843 and the earnings was 28 rupees per share. So we are paying 64 times more for the earnings of the company of the latest year. So this is very expensive. My benchmark is 25 times, not to pay more than 25 times. P&G's price earning was 82 times. For the earning of 124 rupees, we have to pay 10,255 rupees per share, which is again very expensive. Colgate is also trading at 43 times its earnings, and Gillette is trading at 94 times its earnings, very expensive. So all of these companies are trading at extreme valuations. As we go down, we'll understand why market participants are willing to buy at such high premium multiples. Next, let us look at historically where the price was trading against the earnings in the last 5 years and in the last 3 years. In last 5 years, or since last 5 years, the price was trading at 50 times more than the earnings, and in the recent 3 years the price earning multiple was 53 times. So it has always been trading at a high multiple since last 5 and 3 years, and in the current 12 months or the latest price earning has even gone up above the 5 years average. So it has definitely become expensive. P&G also has become more expensive compared to its 5 and 3 years price earning averages. Colgate has seen a slight drop in price earning, although very high, 43 times in the current price earning. But according to the average, it has fallen below both 5 and 3 years, but a mild drop from its averages. Again, very expensive. Gillette is also trading at its high averages of 96 of the last 5 years and 82 times in the last 3 years, and the current is also very high at 94 times. Here we are trying to understand how much profit got converted into cash, and of that cash, how much was used in acquiring assets or investing in assets. After investing in assets, how much was left over as free cash flow to be used in the financing activity. HUL's profit per share was 28 rupees. Out of that, it has actually managed to convert all of that profit into cash, meaning it has received 26 rupees per share as cash against the earnings shown of 28. These are not separate values but one and the same. Here we are trying to understand, if the company has shown a profit of 28 rupees per share, how much of the 28 the company has actually received in cash. So here the company has received 26 rupees out of this 28 in cash, and out of this 26 rupees it still has 23 rupees left over as free cash flow to be used in the financing activity, like giving dividend or doing buyback or giving bonus shares or doing any acquisition or paying off loans and so on. So this is a good ratio. P&G's earnings were 124 rupees per share and has received entire amount of this profit as cash, which is 127 rupees, and again a very minimal amount was invested in acquiring assets, and the balance is left over as free cash of 116 rupees per share. So this is all per share based values. Colgate is also in a very similar line. Same as with Gillette. Out of 74 rupees of profit, 72 came in as cash and 47 is still left over as free cash flow. Comparing the price against the operating cash flow helps us understand what is the multiple we are paying against the actual cash received by the company through operating activities. This is again of the latest year. HUL's price or entire market cap. Here I'm looking at in totality, not in per share based values. So the entire market cap was 3,99,000 crores, against which the company managed to generate a cash of 5,800 crores. That is, we are paying based on the cash earnings of the company. If we have to buy, we would have to pay 69 times more to buy the entire company, or even one share if you want to buy, we'll have to pay 69 times more, regardless of whether we are considering in total or per share based value. The CMP to OCF ratio would be 69 times. Just like price earning, the price to cash is also very expensive. Here too, I don't want to pay more than 25 times. For P&G, we would have to pay 80 times the cash earnings of the company to buy into the company's either per share or the entire company. Colgate Palmolive, for that we have to pay 33 times more. Quite reasonable compared to other group companies, although very high. Gillette is quoting at 97 times its cash earning, very expensive. So these are all valuation metrics. We are trying to understand where the price is compared to different variables, so that we don't buy way too expensive, and we can time our entry based on whether the price compared with different variables is below 25 times. Here we are trying to compare the price against the free cash flow of the company. Here too, we don't want to pay more than 25 times. And as we see, most of these companies are trading at a high valuation again against the free cash flow. Only Colgate has seen it 37 times, that is, the price was quoting 37 times more than the free cash flow of the company. Again, expensive. This does not mean it's bad, it's just that it is expensive. Here we are comparing the price against the book value of the share. This values again is on per share basis. Here we are trying to understand how many times we will have to pay for the book value of the stock. In this case, the book value is the value of the share given by the company. This is what the company is saying its shares are actually worth. And we are comparing it against what the market participants are saying the shares should be actually worth, or what is the value of that share in the market. HUL's share price in the market was 1,843 per share, and the company was suggesting or saying that calculating that its shares were actually worth only 36 rupees. Again, market participants have given a 50 times multiple to the actual share price. Very expensive. Here I don't want to pay more than 2.5 times. P&G is quoting at 36 times its book value. Colgate is quoting at the lowest multiple of 22 times. Again, very expensive. Gillette is quoting at 31 times. Its book value or shares per value as per the company was 221, whereas in the market it was quoting at 7,035 rupees. So valuation wise, all of these companies are very expensive. I don't have any investments in this company, but I'm doing it just to understand why the market would give such high valuations to these companies. As we go down, we'll look at different ratios and see what is the rationale behind giving such high multiple to these companies. Here we are comparing the price with the sales, that is against the market cap. What was the sales the company did? HUL entire company was available for 3,99,000 crores. Against that, the company did a sales of just 39,000 crores. That is a multiple of 10 times. So company did a sales of 39,000 and it was available at 3,99,000. That 10 times more than the sales. Very expensive. Here I don't want to pay more than 3-4 times max. Even that is very expensive. The lower the value, the better. In fact, as near to sales as possible. P&G is quoting at 11 times its sales. Again, all of these companies, if you notice, all of these are very expensive. This is Benjamin Graham's formula, which suggests that we should not pay more than 22.5 times when we multiply the price earning by price book. That is, price earning is suggesting that we should not pay more than 15 times, and for price book we should not pay more than 1.5. This is less than my benchmark. I am ready to pay even around 25 times the price earning and 2.5 times the price book. But if someone wants to be more conservative or want to buy much lower and not give very high price for the company, then they can use price earning into price book and multiply both of them and see whether it is above 22.5 or below 22.5. HUL was quoting at 3,261, which is way too high. The price earning was 64, price book was 50, and when we multiply both 64 with 50, we get 3,260. There's no sense in reading any of these values because they are trading at extreme valuations. So this is the price to different variable analysis that I concluded, and we saw that all the ratios are at extreme valuations. I definitely would not buy into these companies at this kind of valuations. Next, let us look at how the profits have been growing since last 5 years. That is from 2014 to 2019, compounded growth rate in profits, and how the profit was growing in the recent 3 years. HUL's profit was growing at 11.5% since last 5 years. That is from 2014 to 2019. The profit has been compounding at the rate of 11%, which is good. For me, my benchmark is around 10% and more. Even in recent 3 years, we see that the profits have gained a further momentum in growth rates to 14%. So this is much better. This is what we want to see in companies where we invest, that in the recent 3 years, the sales or the profit for that matter should pick up more than what was growth rate in the 5 years. This shows that there is the demand for the companies or the profit generation is growing faster and faster. P&G has seen in recent 5 years or the last 5 years, that is from 2014 to 19, a growth rate of 12.8% in its profits. But in the recent 3 years, it has seen a degrowth in its profit to not even a degrowth, but a mild growth rate of 2.3%, which is definitely means there is some pressure on the profits, and the profit has not managed to grow at a high growth rate of more than 10%, which was there since last 5 years. If somebody wants to look at the actual profit values, they can look at the P&L account, net profit value, and see how the profit has been growing since 5 years and since 3 years. This gives us a good idea as to how the company is managing its growth in profits. Colgate also has seen a single digit growth rate since last 5 years, and in the recent 3 years the growth rate has decreased to 7.8. Gillette since last 5 years was seeing a growth rate of 21.5%, but in the recent 3 years it has moderated to 9.8%. Let us look at the price earning to profit growth rate, that is PEG, that is price earning of the latest year, and we are trying to understand whether that earning for which we paid that high multiple, are we getting growth in that earning? And if we are not getting any growth in that earning, It just does not make sense to pay such high multiple. HUL's current price to earnings multiple was 64 times, as we saw earlier, and we are getting a growth rate in profit since last 5 years at the rate of 11%. So we are paying for the earnings 64 times, and in that same earnings we are getting a growth of 11.5%. So we get a PEG ratio of 5.7. For me, PEG should not exceed 1.5 times. If you want to be more conservative, then you can even expect a PEG of not more than 1 times. Here what is happening is, although we are paying a very high multiple for the earnings, we are not getting a high growth in earnings which we should expect when we pay such high multiples. So all of these companies, as we see, were already trading at a very high price earning multiple, but when it comes to the growth in profits or earnings, it is not translating into that growth. Therefore, the PEGs are very high. Compared with the profit growth of the 3 years, also we see most of these companies are trading at a PEG of 3 years at above 1.5. Again, very expensive. HUL price earning multiple was 64 in the current year, but in the recent 3 years the growth rate in profits or earnings was 14.1%. So when we divide 64 by 14, we get 4.7. So we are looking for even if you are paying a high multiple, but if you are getting a high growth rate for say if you are paying 64 times and we are getting a growth rate in profit of say 30% or so, then also we would get a PEG of around 2 times. So that would again be reasonable, but I am looking for a PEG of less than 1.5. Let us understand how these companies are managing to grow their sales since 5 years and since last 3 years. Here too, like profit, I want the sales to be growing at least 10% and above. Although different sectors would grow at different growth rates, for me my benchmark is around 10%, but otherwise also we can use an average of all the group companies and see which companies have grown above the sector average. HUL's sales has been growing at 6.1% since last 5 years, and in the recent 3 years, just like in profit, the sales have also picked up a bit by 6 to 6.9%. Although this is less than 10%, so I've given it a negative score. All of these companies, if we see, have not managed to grow at a very high growth rates, which we should expect of these companies, because these companies have been given very high multiples. P&G 5 years growth rate was 7.9% in sales, which has declined to 1.7% in the recent 3 years. Gillette India's last 5 years was growing its sales at the rate of 3.3%, very low. But in the recent 3 years, it has seen a degrowth in its sales from where it was 3 years back. That is 2016 to 2019 has seen a fall in its sales. So all of these companies have a negative values to them. In this chart, we are trying to understand how much is the profit generated on the shareholders' money or money contributed by us into the company. And we're going to look at the average of the last 5 years, so we understand the bigger picture as to how the company has been doing in terms of returning profits on our money in the last 5 years. And then we'll also look at what was the return generated in the latest year, which is 2019. Here, equity is composed of the equity plus the reserve of the company. This is the net worth of the company. And we're comparing it against the net profit which was generated. HUL has generated in the last 5 years on average 77% RoE. That is, on our money, the company is earning a profit return of 77%, which is very, very high. Generally, we don't tend to see, or we don't get to see such high returns being generated on the shareholders' money. That is why maybe the shareholders are giving such high premium valuations to these companies, because they're generating such huge returns on the shareholders' money. In 2019, the return on equity was 82%, even higher than the last 5 years average. P&G ROE was 36.4% in the last 5 years, and in 2019 that return has gone up to 56.9%, above its 5 years average, which is again very good. Colgate also had a very high, above 50% return on equity. Gillette has seen the lowest in terms of ROE of 26 and 38% in the recent year, 26.6% over the last 5 years on average. So although these return ratios are very high for all of these companies, Gillette has performed poorly. Next, let us understand what was the profits generated on the assets employed by the company. Now, what are these assets? These are fixed assets plus the current assets minus current liabilities, which is the working capital. So these are the assets employed into the business, and we are trying to understand what is the profit that the company has managed to generate on these particular assets. And we are taking the average of 2018 and 2019 just to level out the amount of assets that will be considered. And in terms of profit, we are considering the EBIT, which is the earnings before interest and tax. Before we deduct interest and tax from the operating profit, we take that as the return in this particular ratio. So we'll look at the RoA of the 5 years on average, and what was the RoA in 2019. HUL had the highest returns on assets, on whatever assets was employed into the business, that is fixed assets plus working capital. On that, it has given a profit of almost the same amount. So it's extremely high. Generally, we don't get to see these kind of returns by any of the companies. P&G also had, over the 5 years, given a return on asset of 55%. Here we are not taking net profit, we are looking at the EBIT. P&G in 2019 gave a return on asset of 89%, again very high. If you look at all of these companies, they're generating huge returns or profits for the shareholders and on the assets that the company is working with. Gillette saw a low RoA of 59.8% in 2019, and on average it was generating a return of 39%. Again, very good values for all of these companies. Now this is the reason why the market is giving these companies such high premium valuations or wanting to buy even at such high multiples. Next, we'll look at the capital employed and what is the net profit that the companies generated on whatever is employed as capital. Here, capital employed is the net worth plus the borrowings, or what was the sources of funds. On that, what was the net profit the company is generating, both over the last 5 years on average and in 2019. Here too, if we notice, all of these companies are generating a very high return on capital employed. HUL over the 5 years on average has been generating 63% on its sources of funds. In 2019 it increased to 65% above the average. Again, very good. Even for P&G it was very high. Colgate was above 57% over the last 5 years on average. And in 2019 it managed a 48% return on capital employed. As usual, Gillette has given the lowest RoCE of 36.8% in 2019. Next, let us look at how these companies have managed to convert its capital employed into sales, or how many times over the capital that was used in the company got converted into sales. This is the multiple we are trying to understand if the sales was higher than the capital employed. So in this case, the green indicates the capital employed and orange indicates the sales the company managed to generate. So if you observe that on 7,966 of capital employed into the business, the company has generated a sales of 39,000, which is very high, which is like 4.9 times the capital employed. So it shows a very high efficiency. All of these companies have generated huge turnover against the capital employed into the business. Next, let us look at how the net profit of the last 5 years that the company has shown, of that how much has been actually received in cash from operating activity. HUL profits of the last 5 years in green is 23,000 CR, against which the company managed to convert all of that earnings into cash of 24,000, meaning whatever profit the company has shown has actually come into the company as cash, which is slightly 4% above its earnings, which is a good value. Most of these companies have managed to generate higher cash against the profit that these companies have shown. So basically this means is that the profits are not being manipulated and they are actually getting converted into cash. Next, let us look at how much of this cash that the companies earned over the period of 5 years has got converted into free cash. That is, how much was left out as free cash after doing investments or doing investing activity or in buying or acquiring fixed assets. HUL had earned a cash of 24,000 CR. Out of that, it still has 21,000 left out as free cash. As I explained earlier, free cash can be used in financing activity to do acquisition or do buyback, bonus, etc. So here, only 14% of this cash of 24,000 was utilized in acquiring assets. P&G cash was 1,974 over the last 5 years, and it has 1,600 left out as free cash. Again, 18% utilized in acquiring assets. Colgate has used 33% in acquiring assets, which is, my benchmark is that companies should not utilize more than 50% of their cash into for acquiring assets. Again, 2,400 was left out as free cash. Gillette's utilization in acquiring assets was 34% of this cash from operations, and 684 is left as free cash flow. Again, good values for all of these companies. In the previous chart, we looked at the 5 years cash flow and the conversion of cash flow into buying of fixed assets. Here we are trying to understand in 2019 what was the profit and how much of that profit got converted into cash. HUL's 2019 profit was 6,200 rupees to 6,200 crores, and the cash coming into the company was 5,800, a shortfall of 7%, which is okay. We don't want, in fact, it's not okay, but we want it to be above the profit that the company has shown. Although this is not a major drop in cash coming in, but anything more than 10% should be taken into consideration as to why the cash coming into the company against the profit shown is less. P&G has seen a 10% growth in cash against the earnings, which is a good value. Colgate has seen a 30% more cash coming in against the earnings, and Gillette has seen a 2% additional cash coming in against the profit. So these three companies have scored well. Okay, in this chart, I'm looking at how the current year's profit is compared with the last 5 years average. That is, whether there is growth in the net profit over its 5 years average net profit. HUL's average profit of the last 5 years, indicated in green, was 4,700. That is, every year on average it was earning this profit. But in 2019 the profit was 6,200, which is above the 5 years average, which is a good indicator that profits are growing, and that growth above the average is 31%. P&G also has seen a 6% growth in its current year's profit and compared to the last 5 years average. Same was the case for Colgate, Palmolive and Gillette, both earning profits above the 5 years average at 19% and 30%. In this chart, I'm looking at the growth rate in profits year on year, that is from 2018 to 2019. What was the growth in profit? HUL has seen a growth in its profit in 2019 from 2018, that is 5,230 crores in 2018 and 6,200 crores in 2019. That's a 19% growth in profit over its previous year. P&G has seen a degrowth in its profit by 14%. In 2018, the profit was 439, and in 2019, the profit has fallen to 379. So there's a fall in its profit. Same is the case for Gillette, where it has seen a decrease in profit from its previous year. Colgate has managed to gain 11% from its previous year. Now we'll look at the quarterly analysis of the sales and profit and how they have been growing in quarter to quarter analysis. So here we have the results up to date till June. So we'll be comparing June 2018 quarter with June 2019. HUL's sales, indicated in green, has grown by 6% over its previous quarter. Again, here too I want a growth rate of 10% from the previous quarter of the previous year. Profits, although, have managed a growth rate of more than 10%. P&G's sales has seen a growth of 23% over its previous year, but the profit has grown only by 8%. Colgate has done poorly in terms of growth rate in both sales and profit. Gillette's sales had increased by a mild 3% over its previous year, but the profit has seen a sharp uprise by 23%. Next, we'll look at what is the contingent liability of these companies. These are the liabilities which may or may not arise in the future, and the thing to understand here is that these liabilities are not accounted for or not shown in the balance sheet or even the P&L account. So these liabilities, or we can say, is hidden liability, which is shown in the notes below the financial statements. So these liabilities have to be considered against the net worth of the company, and they should not exceed more than 20% of the net worth. We don't want to buy into company which has high liabilities which have not been accounted for. HUL's contingent liability is 25% of the net worth. That is, its actual net worth was 7,800 CR, against which its contingent liability stood at 1,960, which is above my benchmark of 20%. Only P&G has seen its contingent liability below 20%. Rest, Colgate Palmolive's contingent liability is very high at 41%, and Gillette's liability is even higher than the net worth. So I would not want to invest in a company whose contingent liability is more than the net worth. Generally, we would see these kind of ratios in banks where they work on leverage. So definitely not a good value to look at for Gillette. Debt to equity ratio. In this, we are looking at how the company has been funding its operations. Is it more through internal funds or through external borrowings? And what is the debt burden on these companies? As we can see, none of these companies are having any debt on them. In fact, all the three, Hindustan, Unilever, HUL, P&G and Gillette, all three are debt-free companies. Colgate has a mild debt of 83 crores against the equity contribution of 1,447. And Hindustan, HUL, has 99 crores of debt against an equity of 7,800, a very almost negligible debt. So all of these companies' debt is zero and a good ratio. We don't want debt to equity to exceed 1 times for any of our companies. Debt to profit ratio. In this, we are looking at what is the debt the companies are carrying and whether the profit these companies are generating, would that be able to service this debt. Since none of these companies have any debt, as we saw in the earlier graph, most of this profit is for the company to keep and it has nothing to pay against the debt. So all of these ratios would be okay. Again, here we are looking at the interest cost and we are comparing that interest cost against the EBIT. So out of this EBIT which the company earned, how much it paid as the finance cost or the interest cost, that is known as interest coverage ratio. Now, since none of these companies have any debt, their interest cost would be also negligible or almost zero. So HUL earnings before interest and tax was 8,800, against which it paid an interest of just 33 CR, which is a ratio of 268. That is, EBIT was 268 times higher than the interest paid. Of course, all of these will be very high coverage because their debt portion, that finance cost is very low because they don't have any debt. Next, let us look at what is the promoter's stake in the business using promoter holding. And if the promoter holding is high, they would have a higher incentive to keep running the business in an efficient manner. And if any of the promoters have pledged their shares and borrowed money on that, HUL promoter holding was 67%. In fact, all of these companies' promoters are holding more than 50%. And none of the promoters have pledged any of their shares. So these are all very good values. Next, let us understand what is the raw material cost as a percentage of sales. That is, out of the sales done, how much of that sales or how much of the expenses out of the sales was for raw material. HUL's raw material cost was 40% of the sales. P&G's was 39%. So we see all of these companies raw material cost is very nearby to each other. This we can compare against each other to understand if a certain company's raw material cost is high, and when the raw material cost becomes high, it means the company doesn't enjoy the bargaining power that it should command in terms of raw material. So all of these ratios are very nearby to each other. So these are all good ratios. We don't want raw material cost as a percentage of sales to exceed 85, which is again very high. Next, let us look at the debtors or accounts receivables that the company has to collect. These are also the customers from whom the company has to collect, also known as debtors. And against this, what was the sales done by the company? So we don't want a very high percentage of debtors to be still collected against the sale of the latest year. For me, these collections should not be more than 30% of the sales. HUL sales was 39,310 CR in 2019, against which the payment to be collected from the customers was just 1,816 CR. So this is a good value. The green indicates sales and orange indicates the debtors or accounts receivables. So this is just 4.6% of the sales. That is, out of this sales, only 1,800 was still pending to be collected from the customers. A very minuscule amount for the company. In fact, most of these companies have been doing very efficiently in terms of collecting payment quickly from the customers. Not much of the payment is pending with the customers. Okay, next let us look at how many days the companies are taking to collect payment from these customers. So we already saw for HUL that its collection from debtors was just 4.6% of the sales. That is okay, but not only this is low, but it is collecting whatever is pending from the customers within 17 days in 2019. 3 years back, it was collecting the payment from customers within 14 days. So this is the credit period or credit days the company is giving to its customers. And even P&G had a good collection days of 22 and 18 days, slightly increased from 3 years back. The bar in blue indicates what was the collection days 3 years back. If you notice, all of these companies collection days have gone up from where it was 3 years back. Colgate, this could also be because there could be pressure on the company to give more credit days to the customers. Colgate's collection days have also gone up to 17 from 10 days 3 years back. Only Gillette has seen a very high collection days from 23 3 years back. It is taking now 38 days to collect payment from the customers. Not only that, its collection as a percentage of sales is also high. The number of days it is taking is also very high. Next, let us look at the debtors and compare it with the creditors. That is, how much the company has to receive and how much it has to pay to its suppliers. So whenever the company has to pay more to the suppliers, it means that it is enjoying a good reputation in the market. HUL's payment to be done to the suppliers was 7,160, against which It has to just collect 1800 CR from the customers. So there's a gap of 3.9 times. So the balance amount between the two is the value that the company enjoys. It uses this as interest free. P&G also managed a 3.1 times the debtors to creditors ratio. That is, the payment to be collected from customers was just 197 CR, against which it had to pay 605 CR to its suppliers. So that's a multiple of 3.1 times. And most of these companies are enjoying good working capital, we can say, against the debtors. So they are enjoying good amount of money from suppliers to be used as interest free. In this chart, we are looking at the average operating profit margin these companies have earned over the period of 5 years, and how much of that OPM has got converted into net profit margin in 2019, and what was the NPM in 2018. HUL's OPM over the last 5 years was 19.7%. My benchmark is that the operating profit margin should be above 15%. So this is good. Even the NPM, my benchmark is 10% and above. So all of these companies, if you see, all of these companies have managed an NPM in the latest year of more than 10%. Even in 2018, the NPM was in the double digits. OPM for all of these companies was also high, except for Gillette, which was very near to the benchmark of 15.4%. Next, let us look at the current ratio and the working capital requirement of these companies. Green indicates current assets and orange indicates current liabilities. Current assets are those assets which the company can sell or will be selling in 1 year's time, and current liabilities are those liabilities which the company has to pay within the current year. This is a liquidity ratio which helps us understand whether the company can clear or service its current liabilities using the current assets. So we want the ratio to be more than 1 times. Only Colgate has seen its ratio falling below 1, that is, its current assets were just 1010 crores, but its current liabilities were slightly above that at 1077, a minor working capital requirement of 66 CR. Rest all of the companies are having a good current ratio, that is, they are in a comfortable position to clear off their current liabilities using the current assets. The blue indicates the additional assets these companies have which can be used in increasing the sales of the company or in the growth of the company. Next, let us look at what is the size of the gross asset at its acquisition cost, that is, how much assets the company owns at its acquisition cost, and out of that how much depreciation has got accumulated or has already been expensed out to the P&L account. HUL's assets is 6,459 crores. Out of that, 1,744 has already been deducted as expense from the P&L account in the past years. That is, 27% of that has already been depreciated. So the balance of that is out of the 100 needs to go to the P&L in the future years. So here anything about 20-25% is a good value. There is no fixed benchmark here, but the higher the better. P&G has already accumulated depreciation of 37%. Out of this 400 crores of assets at the acquisition cost, 150 crores has already been depreciated to the P&L account in the past years. Colgate Palmolive has transferred 32% of the depreciation to the P&L account, and Gillette has transferred 29%, that is 109 crores in the past years, into P&L account. So here, the higher the better. Finally, let us look at the net block, that is, once we remove the accumulated depreciation from the gross block, we get the net block or the net assets the company has, and on that, what is the depreciation charged, at what percentage these net blocks are getting depreciated to the P&L account every year. So this will give us an idea as to how the depreciation is going to affect the net profit in the future years. HUL is deducting its assets of 4,715. These are the net assets at 565 crores every year. That is 12% depreciation rate. So every year 565 crores is getting deducted from the net profit of the company as expense. Although this is a non-cash expenditure, but for P&L calculation we have to remove the depreciation as an expense. P&G is removing 21% of its assets as depreciation. Out of 247 crores of net assets, 52 crores was depreciated in 2019. That is, this was the value which was transferred to the P&L account as depreciation cost. So most of these companies are depreciating at a high rate of double digit. So the higher the better. That shows that company is not manipulating its profit. So this concludes my analysis based on the graphs. We'll switch over back to the Excel sheet and I will score all of these companies as per the ratios, and then we'll conclude this analysis. I have given scores from +4 to -4 depending on what each ratio is indicating. For example, if the face value had a split and the face value was 1, the lowest of them would get the lowest score, and the shares which don't have any split would get the highest mark. The ratio where we look at how the price has fallen from 52 weeks high. Here the maximum fall would get the lowest score and the lowest fall would get the maximum score, and so on. For like the highest earnings yield would get the highest score, the lowest price earning would get the highest score. In terms of price to operating cash flow, the company whose price to operating cash flow has the lowest ratio or multiple would get the highest score. In this case, Colgate had the lowest price to operating cash flow ratio of 33 times compared to the other three companies. Therefore, it has got the lowest score of -1. In fact, it has got the highest score of -1 because we are getting it at the most economical rate compared to the group companies. This has been given negative because it is above my benchmark. So any ratios that go above my benchmark would get a negative score. But since all of these ratios have gone above my benchmark, the lowest would get the highest point. So in this sense, -1 is the highest. So on for all of these companies. So after giving scores to all these companies, ratios, I find that Hindustan Unilever had the highest points of 77, P&G scored 63, Colgate Palmolive scored 57, and Gillette had a 17 score. So Gillette has scored the lowest. I have combined all of these ratios into different metrics. I have 6 different metrics: efficiency, cash flow, valuation, return ratios, growth ratios, and solvency metric. All of these I have covered little later on in the video. Right now I'm just leaving this chart on for 5 seconds each for anyone who wants to note down these values or look at these values. They can pause the video and look at these scores. I'll be changing them after every 5 seconds. Okay, I have combined all of these individual ratios into different metrics. As I mentioned, I have given efficiency metric the highest weightage of 6 points. Cash flow comes next at 5 points, 5 weightage. Growth metrics has 4 weightage. Return metrics has 3 weightage. Solvency has 2 and valuation metric has 1 weightage. I'll quickly go through what each metric or what ratios are included in each metric. Efficiency covers how efficiently the company has turned over its assets into sales. How much contingent liability is there against the net worth? What is the debt against the equity? How much borrowings the company has done against the shareholders' money? What is the interest coverage? That is, how much interest the company is paying against what it is earning as earnings before interest and tax, or EBIT. How much is the borrowings and what is the profit the company has earned? So can it cover its borrowings using the profit it has earned? How much is the sales against the debtors? That is, what is the amount still to be collected against this year's sales? How many days it is taking to collect payments from the customers? What is the inventory turnover? That is, how many times over the inventory was converted into sales. Although I have not included this ratio in this particular analysis. How much is the accumulated depreciation against the total assets that the company had, including the depreciation? What was the depreciation rate charged on the net block? That is, how quickly was it depreciating its assets over to the P&L account. In the cash flow metrics, we'll look at how the profit has got converted into cash over the period of 5 years and even in the recent year. How much of that cash is still left over as free cash to be used in the investing activity. And as I mentioned, the conversion of profit into cash of the latest year. In the growth metric, we are looking at how the sales has been growing and from last 5 years and 3 years, even quarter on quarter or year on year, and over its 5 years average. What was the growth rate in return on equity? How is the sales and profits both growing? What is the net worth of the company? In the return metric, we are looking at the profitability or the profit returned on shareholders' money, on the assets employed or on the capital employed, the net profit margin earned, the operating profit margin over the last 5 years, and what is the earnings yield. Solvency would look at what is the promoter holding and if they have done any pledge and what is the current ratio. In the valuation metrics, we are looking at price earning of the latest 12 trailing months and comparing it with the average of last 5 and 3 years. Where was the price against the operating cash, against the free cash, against the book value, and what was the difference between the market cap and the sales? What is the PEG of both 5 and 3 years? So these are the combined ratios, and we have 6 different metrics. As I mentioned, for me, efficiency is the most important, as in this ascending order or as in descending order. The cash flow is given the weightage of 5 and so on. For me, valuation comes last because this is not very important until unless all of these other top ratios are in order. In terms of efficiency, HUL and P&G have done the best. They have the best efficiency ratio. Gillette's efficiency ratio is the lowest. In terms of cash flow, the best conversion of profit into cash was done by P&G and Colgate. HUL has managed a low score of 20. We'll quickly look at why it is so low. So if you observe, out of the cash flow, out of the profit earned, the cash flow from operations was just 3.8% higher than the profit, which is good. It's not a bad thing. But compared to the other peer group companies, it has generated low cash against the profit at only 3.8% above the profit. And in terms of free cash flow, it has utilized the least amount in investing in assets against what cash it earned. And if you look at the latest cash from operations here too, the cash coming in through operating activity has fallen below the net profit shown in the latest year. This is the only company whose cash has fallen short of the net profit. Again, the cash coming from operations was 6.6% short of the net profit, and rest of the other companies had scored or generated higher cash than the net profit. Although this is still okay, but since we are comparing it, it has got the lowest score. In terms of growth metric, growing its sales and profit, HUL has managed to grow both its sales and profit at the highest percentage. Colgate has fallen. Growth and sales have not grown at that pace when compared with the peer group companies. Gillette has managed a good growth rate in sales and profit, but highest was done by Unilever. In terms of return metric, that is profitability metrics, highest score again was for both HUL and Colgate. Both have scored almost the same points in terms of return metrics. The lowest score was by Gillette. In terms of solvency, P&G has done the best along with Gillette. That is, the promoter shareholding may be high and their current ratio may be high. Again, Colgate Palmolive has got the negative score, so the solvency metric is low in this particular company. As we saw, most of these companies' promoter holding was very high and there were no pledge, so that is not an issue. But in terms of liquidity, this company may be facing some issue in terms of having low, or that is, its current assets may be less than its current liabilities. In terms of valuation metric, the highest points, because since all of these are very highly valued scripts, their scores are negative, but the lowest score means the lowest negative point means the highest score. So in this case, Colgate Palmolive and HUL have the best valuations. Even though they are more high, still when compared with the group companies, it has the best valuations. Gillette has the highest negative points, so it is the most expensive compared to the peer group companies. Anyways, I wouldn't be buying into any of these companies because their valuations are very high. This is just for my understanding to analyze these companies as to why these companies are trading at such high premium valuations. Why are market participants or investors willing to give or buy these scripts at such high book value price to book value, price to sales, price to earnings, price to cash, and so on. So what I understood out of this was that the returns generated by these companies on shareholders' money was very high, and since shareholders are investing in these companies, they would want to see a high growth in profits on their money. Even on capital employed and total assets deployed by the company, the returns generated were very high. So after giving all the scores, we find HUL has the first rank, followed by P&G. Third rank was for Colgate Palmolive, and the last was Gillette at 148 points. I would suggest, if somebody would want to buy it even at such high valuations, to go for HUL and P&G. Although I personally wouldn't buy into any of these scripts. I use fundamental analysis just to understand if I should be buying into the companies, and at what levels I should buy is based on technical, specifically the relative strength index or RSI oscillator, and then I look at the support and resistance levels to see where I can buy into these companies in a staggered manner. I don't buy at one go. I break up my whatever I want to invest into multiple parts, and then look at where the supports are and put my money at those support levels to buy into the company. Thank you for watching this video.